For years, cryptocurrency existed in the margins of traditional finance, treated as a speculative asset class by bankers, dismissed by regulators, and largely excluded from mainstream financial infrastructure. However, 2025 marks a pivotal turning point where this narrative is fundamentally shifting. Major banks around the world are no longer viewing cryptocurrencies, particularly XRP and related blockchain technologies, as a niche curiosity to be avoided. Instead, they're actively integrating these technologies into their core operations, recognizing the transformative potential of blockchain-based payment systems. This shift represents one of the most significant developments in financial technology in recent decades, and understanding what's happening requires diving deep into the mechanics, motivations, and implications of this transformation. The significance of this moment cannot be overstated. When institutions like Santander, SBI Holdings, PNC Bank, and American Express, companies that collectively manage trillions of dollars in assets, begin prioritizing cryptocurrency integra, it signals a fundamental acceptance of digital assets as legitimate financial infrastructure. This isn't speculation. This is institutional adoption backed by real business value propositions and practical implementation across multiple jurisdictions. The problem banks are solving. To understand why banks are embracing XRP and similar technologies, we must first understand the fundamental PAI endpoints in the current global banking system, the existing infrastructure for international payments, predominantly based on the SWIFT Society for Worldwide Interbank Financial Telecommunication System, was designed in the 1970s. While it represented a revolutionary improvement at the time, it's now showing its age in an increasingly digital, real-time world, cross-border payments through traditional banking channels typically take between 3 to 5 business days to settle. During this period, funds are held in various Nostro and Vostro accounts that banks maintain with each other to facilitate transactions. This system requires multiple intermediaries, each taking a cut and adding layers of complexity for businesses and individuals sending money across borders. The current system involves lengthy processing times, opaque pricing, and significant fees that can reach 5 to 10% of the transaction amount for certain corridors. Furthermore, traditional systems lack transparency. When money is sent internationally, neither the sender nor the recipient has clear visibility into where the funds are at any given moment or what's happening to them during the settlement process. This opacity creates friction, requires trust in multiple institutions, and opens the door to potential loss of funds if any intermediary fails or makes an error. For developing nations and emerging markets, the situation is even more acute. Banks in these regions often lack access to efficient payment corridors, making it expensive and time-consuming to move money internationally. This has profound implications for remittances, money sent by migrants to family members in their home countries. According to global financial data, remittances constitute a significant portion of GDP in many developing nations, and the current inefficiencies in sending this money result in billions of dollars lost to fees annually. Into this landscape comes XRP and blockchain-based payment networks like RippleNet PR, promising to solve these foundational problems with near instantaneous settlement, transparent pricing, reduced intermediaries, and dramatically lower fees. The XRP and Ripple solution framework, Ripple Labs, has developed a comprehensive ecosystem designed to integrate into existing banking infrastructure while leveraging the efficiency of blockchain technology. XRP, the cryptocurrency at the heart of this ecosystem, serves as a bridge asset that enables instant liquidity without requiring banks to hold large reserves of every currency they conduct business in. Here's how the system works in practice. When a bank in Japan wants to send funds to a bank in Brazil, traditionally they would maintain accounts in multiple currencies, paying interest on capital they hold in reserve. With Ripple's demand liquidity ODL service, which uses XRP, the transaction becomes nearly instantaneous. The Japanese bank converts yen to XRP. The transaction settles in seconds on the XRP ledger, and the Brazilian bank receives the XRP and converts it to Brazilian reals. The entire process takes minutes rather than days, and the costs are a fraction of traditional methods. The technical architecture of XR P is engineered for this purpose. The XRP ledger can process up to 1,500 transactions per second, with fees averaging $0.0002 per transaction. These aren't theoretical maximums either. They've been demonstrated repeatedly in live production environments with real institutional money. Compare this to Bitcoin, which handles approximately 7 transactions per second, or Ethereum, which operates at roughly 12 to 15 transactions per second without layer 2 solutions. The scalability difference isn't marginal, it's fundamental. RippleNet itself functions as an overlay network on top of existing banking infrastructure. Banks can adopt RippleNet to improve messaging between institutions, share information more efficiently, and eventually integrate ODL for actual payments. This gradualist approach has proved ineffective because it doesn't require institutions to abandon legacy systems overnight. Instead, they can layer Ripple's technology on top, experimenting with lower value transactions before committing larger volumes. Major banks driving adoption. Who's leading the way? The list of major financial institutions implementing XRP technology has grown substantially and includes some of the world's same prominent banks. This isn't speculation about future adoption. This is current ongoing implementation. Japan's revolutionary commitment. Japan represents perhaps the most remarkable case study of institutional XRP adoption. SBI Holdings, one of Japan's largest financial services conglomerates, has been partnered with Ripple since 2016 and views XRP as transformational for Japan's remittance INF. Structure. The company has invested heavily in Ripple, formed joint ventures like SBI Ripple Asia to expand adoption across East Asia, and develop financial products specifically designed to promote XRP usage. More significantly, according to reports from 2025, Japan's banking sector is moving toward comprehensive XRP integration. The goal is to have nearly 80% of Japan's banks integrating XRP into their systems by the end of 2025. This isn't happening in isolation. The Bank of Japan itself has been supportive of this modernization effort, recognizing that updating the nation's financial infrastructure to support digital assets and blockchain technology is critical for long-term competitiveness. Yoshitaka Kitao, the CEO of SBI Group, has been vocal about XRP's potential, particularly for international remittances. Japan has a large population of migrant workers, and the ability to send money home efficiently has profound social implications. With XRP-based systems, remittances that once took days and cost significant fees can now be processed in minutes with minimal costs. European and American institutions, Santander, the Spanish banking giant with operations across the Americas, ND Europe launched OnePayFX in 2018 using Ripple's infrastructure. The platform allows customers to send money internationally with near-instant settlement and lower fees compared to traditional methods. Santander has been methodically expanding this service, demonstrating that blockchain-based payments can work at scale with real retail customers, not just institutional transfers. PNC Bank, on of America's largest diversified financial services institutions, has implemented Ripple's blockchain solutions to offer near instantaneous cross-border payments to its commercial clients. For a bank of PNC's scale and regulatory complexity, adoption represents significant institutional confidence in the technology and its compliance characteristics. American Express has partnered with Ripple to enable faster B2B transactions, particularly important for business-to-business payments, where speed and cost efficiency directly impact competitive advantage. For a company as large and traditionally oriented as American Express, such a partnership signals recognition that blockchain technology is not a temporary trend, but a fundamental upgrade to payment infrastructure. MUFG, Mitsubishi UFJ Fina, NCL Group, Japan's largest bank, has adopted Ripple specifically for the ability to reduce settlement times from days to seconds. The appeal for a mega bank is straightforward. Reduced settlement time means faster capital velocity, which translates to competitive advantage and operational efficiency. Standard Chartered, an international bank with significant presence in Asia and emerging market, has implemented XRP integration for cross-border payments. Given Standard Chartered's focus on emerging markets and remittances, the efficiency gains from XRP adoption are particularly significant. Additional institutional players beyond these household names Dozens of other banks and financial institutions globally have integrated XRP technology or are actively experimenting with it. This includes PNC Bank, Switzerland's first bank to use XRP for real-time cross-border transfers, Banco Rendimiento focused on remittances within Latin America, and a growing list of regional and international financial institutions recognizing XRP's utility. The numbers behind institutional adoption. The impact of this adoption becomes clear when examining the metrics. As of 2025, major banks U.S. eyeing Ripple technology have reported significant improvements in their operations. Transaction times have been reduced from multiple days to seconds. Costs have been slashed, with some institutions reporting up to 90% savings compared to traditional payment methods when using XRP-based solutions. XRP's market metrics reflect this institutional adoption. The cryptocurrency has reached market capitalizations exceeding $186 billion, with daily trading volumes surpassing $7 billion. These aren't numbers reflecting retail speculation. They represent institutional utilization of a cryptocurrency as a working payment asset. When major banks conduct billions of dollars in daily volume using an asset, that asset has achieved something fundamentally different from speculative instruments. It has real world utility backed by institutional demand. The active address growth on the XRP ledger has grown 300 to 400% in recent periods, indicating expanding network effects. More institutions joining means greater utility for existing participants, which attracts additional institutions in a virtuous cycle. This is precisely how network effects work in payment systems. The value increases exponentially as more participants join. Regulatory clarity, the game changer. One of the most significant developments enabling bank adoption has been regulatory progress. For years, the SEC's lawsuit against Ripple created uncertainty about whether XRP was a security or a commodity. This ambiguity deterred institutional adoption. Why would a major bank integrate an asset whose regulatory status was contested? Owing favorable court rulings in 2024 and the SEC's apparent decision to settle its case in 2025, the regulatory landscape shifted dramatically. The court's determination that selling XRP to institutions qualified as a security sale, while sales to regular investors on exchanges did not provide a legal framework for institutional adoption. With this clarity, barriers to large-scale banking adoption were substantially removed. Additionally, Ripple's recent move toward becoming a licensed financial institution in the United States, including obtaining conditional approval from the Office of the Comptroller of the Currency to establish Ripple National Trust Bank, further legitimizes the company and reduces counterparty risk for institutions using its services. When a cryptocurrency company, CAN, become a licensed bank, it signals institutional maturity and regulatory acceptance. Technical roadmap driving institutional appeal beyond current adoption. Ripple's technical roadmap for 2025 and beyond reveals why institutional adoption is accelerating. The company is implementing features specifically designed to appeal to institutional investors and banks, demonstrating long-term commitment to making the XRP ledger the preferred platform for enterprise blockchain applications. The planned EVM sidechain, expected second quarter 2025, would allow Ethereum developers and applications to deploy on the XRP ledger ecosystem, dramatically expanding the developer ecosystem and applications available on the network. This bridges the gap between the large and vibrant Ethereum developer community and the institutional-grade infrastructure of the XRP ledger. Multi-purpose tokens, MPTs, represent another crucial development. These semi-fungible tokens are designed specifically for real-world asset tokenization, the process of converting physical or financial assets into digital tokens on a blockchain. This capability enables banks to tokenize bonds, structured products, ROAs, real-world assets, and for financial instruments, for institutional finance. This feature represents the ability to bring the efficiency of blockchain infrastructure to traditional financial products. Enhanced security features and compliance tools are being integrated to meet institutional requirements. The focus on regulatory-friendly blockchain architecture means the XRP ledger is being positioned as the de facto standard for compliant institutional-grade blockchain applications in finance. The broader cryptocurrency adoption trend. While XRP receives particular attention due to institutional adoption, it's important to understand that XRP is part of a broader cryptocurrency adoption trend by banks and financial institutions. However, XRP's specific design for payments and institutional use cases gives it particular momentum in the banking space compared to other cryptocurrencies. Other cryptocurrencies are finding institutional adoption in different contexts. Bitcoin for store of value applications, Ethereum for complex financial applications and smart contracts, stablecoins for stable value holdings. But XRP's niche as the payment optimized cryptocurrency for institutional cross-border settlement is becoming increasingly well-defined and well-served. This specialization matters. Rather than being a generalized cryptocurrency competing across multiple use cases, XRP is becoming synonymous with efficient institutional payments. This focus brings institutional credibility because banks care about currencies that work reliably for their specific needs, cost and efficiency transformations, the FINA. NCIL impact of XRP adoption on banking operations cannot be understated. Traditional cross-border payments require maintaining nostro accounts banks hold in foreign currencies to facilitate settlements. These accounts tie up significant capital. With XRP-based liquidity provision, banks can dramatically reduce capital locked up in nostro accounts, freeing up billions of dollars across global banking system that can be deployed toward other productive uses. For a mid-size international bank conducting thousands of cross-border transactions daily, the efficiency gains compound. If each transaction saves 3 to 5 days of settlement time, that represents millions of dollars of capital velocity gains. If each transaction costs 80 to 90% less than traditional methods, that represents direct profit increases on those transactions. For remittance corridors serving developing nations, the savings are even more profound. Money sent by migrants to families in countries with less developed financial infrastructure often goes through multiple intermediaries, each extracting fees. XRP-based systems can collapse these intermediary chains, delivering more money directly to recipients while harging lower fees, market dynamics, and price implications. The institutional adoption of XRP has profound implications for supply and demand dynamics. When major banks integrate XRP into their payment systems, they need liquidity available in XRP to facilitate transactions. This creates institutional demand for XRP that differs fundamentally from speculative retail demand. As banks expand their U.S. of XRP-based services, they need to hold XRP reserves to ensure liquidity for customer transactions. A single major bank integrating XRP across multiple geographic markets might need to hold millions of dollars in XRP reserves. Multiply this across dozens of banks globally, and the aggregate XRP holdings required by institutions create significant ongoing demand for the asset. Furthermore, as transaction volumes increase on the network, the value of having XRP as the settlement asset increases due to network effects. Bigger network means faster confirmations are possible, better liquidity pools for converting between XRP and various fiat currencies, and lower overall costs. This creates a self-reinforcing cycle where institutional adoption drives network utility, which attracts more institutional participants, challenges, and realistic perspectives. Despite the remarkable progress in institutional adoption, important nuances and challenges should be acknowledged. While major banks are integrating XRP and blockchain-based solutions, it's important to recognize that in most cases, these implementations represent additions to existing infrastructure rather than complete replacements. Many banks are running RippleNet and XRP solutions in parallel with traditional SWIFT-based systems, not exclusively using blockchain. This is a rational approach. SWIFT is entrenched, has deep relationships and established security protocols, and many transactions continue through traditional channels. However, as XRP solutions prove reliable and cost-effective, the proportion of transactions flowing through blockchain-based systems is increasing. Regulatory risks persist. While the SEC case has been settled, regulatory approaches to cryptocurrency vary significantly by jurisdiction. Some countries remain hostile to cryptocurrency adoption, which could limit global scaling of XRP adoption even if it's successful in crypto-friendly jurisdictions. Technical risks also exist. While the XRP LE Dger has proven highly reliable, no system is perfect. Any significant technical failure or security breach could undermine the confidence that institutions have placed in the system. However, the network's track record in managing high-volume institutional payments without major incidents is reassuring. Competitive risks should also be noted. Other payment systems and cryptocurrencies are evolving. Stablecoins, central bank digital currencies, CBDCs, and other layer 2 payment solutions are being developed. XRP's future dominance is not guaranteed, though its head start in institutional adoption and specific optimization for payments gives it significant advantages. The macro picture, what this means for finance, the shift toward bank adoption of XRP and blockchain-based payments represent a structural change in how global finance operates. The current system, based on decades-old infrastructure, multiple intermediaries, and days-long settlement times, is becoming obsolete in a world where near instantaneous communication and settlement are technically feasible. This transition won't happen overnight. Institutional inertia is real, and existing systems have deep roots. However, the competitive pressure is relentless. Any major bank that lags in adopting efficient payment technologies risks losing business to competitors who can offer faster, cheaper, more transparent services. This creates an arms race where institutions feel compelled to implement advanced payment solutions to remain competitive. The implications extend beyond banking. As blockchain-based payment systems become mainstream, the entire financial ecosystem benefits. Remittance costs decrease. Developing nations gain access to more efficient financial infrastructure. Small businesses gain access to lower cost international payment options, and the global financial system becomes more efficient overall. Furthermore, this adoption validates the broader blockchain technology space. When major institutions adopt blockchain-based systems for critical financial operations, it demonstrates that blockchain isn't just theoretical. It's practical, reliable, and valuable infrastructure. This validation makes institutional adoption of other blockchain-based financial applications easier to justify. The role of stablecoins in bank adoption. Many institutional implementations of Ripple Net pair XRP with stableco, INS, particularly RLUSD, Ripple USD, Ripple's own stablecoin. Stablecoins serve as a bridge between the volatile world of cryptocurrencies and the stable value expectations of banking. By using stablecoins alongside XRP, institutions can capture the efficiency and settlement speed of blockchain without exposure to cryptocurrency volatility. RLUSD and similar stablecoins represent the practical instantiation of blockchain-based payments for institutions. Rather than dealing with price volatility of XRP, banks can send funds using stablecoins that maintain predictable value. The development of Ripple's banking license and regulatory approval to manage RLUSD reserves further legitimizes this approach in the eyes of regulators and institutional participants. Timeline of major developments. The pathway to 2025's institutional adoption has been years in development. Beginning with Ripple's founding and early partnerships with banks like SBI in the mid-2010s, the company has methodically built relationships with financial institutions. The launch of RippleNet and ODL services provided the infrastructure for institutional adoption too. The SEC lawsuit created years of uncertainty from 2020 to 2024, but the resolution of that case cleared the path for acceleration. The period from 2024 to 2025 has witnessed rapid expansion. Regulatory approvals have been granted, new partnerships have been announced, and banks that had been cautiously watching have begun implementing systems. The momentum heading into 2026 appears stronger than ever, with multiple institutions in advanced stages of integration. Looking forward, what comes next? As we look beyond 2025, several trajectories seem likely. Further bank adoption across jurisdictions will almost certainly continue, particularly in Asia Pacific and emerging markets where efficiency gains are most pronounced. Japan's plan for widespread banking adoption could catalyze similar initiatives in other developed markets. The technical roadmap described earlier, EVM sidechains, MPTs, enhanced compliance features, will likely expand the use cases beyond pure payment settlement into tokenization of assets and other financial applications. This could create a broader ecosystem where the XRP ledger becomes a standard infrastructure layer for institutional finance, the development of CE. NTRL bank digital currencies, CBDCs, may create additional opportunities. If major central banks issue digital currencies, they'll need infrastructure for international settlement between CBDCs. XRP and Ripple's infrastructure could become a preferred settlement layer for international CBDC transfers. However, success is not guaranteed. Competitive technologies, regulatory setbacks, or technical failures could derail momentum. The space remains dynamic and subject to surprises. Nonetheless, the direction of travel seems clear toward greater institutional adoption, greater institutional presence in what was once a purely retail-focused asset class, and fundamental transformation of how global payments infrastructure operates. Conclusion: the transformation is real. The headline banks Majo. RAI promoting XRP and crypto captures real, significant developments in how global finance operates. This isn't hype or speculation. Major institutions with trillions in assets are actively implementing blockchain-based payment systems. The regulatory uncertainty that long plagued cryptocurrency adoption has largely cleared. The technical infrastructure has proven capable of handling institutional scale transactions. What's happening in 2025 represents a inflection point. The transition from cryptocurrency as a fringe asset class to cryptocurrency as a fundamental infrastructure layer for institutional finance is underway. XRP, due to its specific design for institutional payments and the ecosystem Ripple has built around it, is at the forefront of this transition. For those following the development, it's worth recognizing that this is not the speculative cryptocurrency market of previous cycles. This is institutions betting that blockchain technology solves real problems in their operations, and they're implementing systems based on those beliefs. Time will tell whether this institutional adoption accelerates further or faces unexpected obstacles, but the trajectory has clearly shifted toward greater integration of blockchain-based solutions into mainstream banking.